So, Professor, you and I have discussed the question of stock buybacks. I think at first we talked about it was several years ago, and this comes out of research you did about what the implications of stock buybacks have meant to corporate America. But before we get to that, just give us a little. I don't think that most people, frankly, know that 30 years ago, and I guess maybe it was closer to 40 years ago, stock buybacks it was criminal to do that.
Well, it could be criminal, yeah. So I'll just give you some background on that, and the readers let them know where this thing came from. So basically, first of all, I think what everybody has to understand is that any company, if it's going to produce competitive products, get high productivity, pay its workers well, it has to make profits and reinvest those profits. That's the foundation of corporate finance. And if it starts paying out too much money out of a company, you're going to pay for it in terms of the competitive position, and the workers are going to pay for it. And actually, taxpayers are going to pay for it too if the companies say in order to compete they need lower taxes, which they always do, because we support those companies through government investment in infrastructure and knowledge and all kinds of subsidies. Okay, so when companies make profits, you want them to be able to keep their workers employed, to pay them the productivity those workers help generate, and to reinvest in both keeping those products competitive and the next round of competitive products, because what generates profits today doesn't necessarily generate profits in the future. And in a corporation that's publicly listed, traditionally, what happens is that when companies have done that and have some money left over, they pay dividends to people who hold shares. And the people who hold shares are really not active in the company generally. They're people who just buy and sell shares on the market. They're households really just trying to save their money, and the dividends give them an income. And that's the way things were coming into the 1980s. At that time, the debate in business schools and in boardrooms was often, are companies paying too much dividends given that you need to reinvest in the company? But at that point, you had a change, and it really was totally the result of Ronald Reagan getting elected on a deregulation platform. You had a change in the view of how corporations should be governed, which later, it didn't really happen right at that point coming in the 80s, but by the mid-80s it was kind of virulent, and that is the company should be run for shareholders, of maximizing shareholder value. So that's something that really became the creed of corporate governance, and still is in the 80s and beyond.
And just to be clear, this notion of shareholder value in judging the success, I guess, of a company, what was the measure of success prior to that? Like how would conceptually, what was that?
Well, I think the measure of success was generally not your stock price. I mean, people might have looked at the stock price, but people looked at, did the company keep people employed? It's a good place to work. Did they pay higher wages? Did they help drive up wages in the economy? Did, under affirmative action, for example, in the late 80s and 90s, were more minorities and women employed in those companies? There was a notion of a company not necessarily as a social philanthropy, but at least as an entity that was central to the economy, where people went and worked hard, and the gains were shared in a way that we could have a prosperous middle class. And that started to disappear in the 1980s. And shareholder value was really the ideology. It helped make it disappear, and it helped to say, no, we don't need to worry about the people we employ. We don't need to worry about the government, the fact the government is funding infrastructure and knowledge and giving us subsidies. Let's just give what they call returns and to shareholders. Now, these words are ideologically loaded, because when you say return something to someone, is that they gave you something. Well, actually, shareholders don't generally give companies money. They buy outstanding shares. And when a company goes public, for example, the venture capitalists call it an exit strategy. They now can sell their shares and cash in. And this is the ideology that came basically out of economics, not necessarily challenged by liberal economists, but particularly out of Chicago economics at first, and then became dominant, that the only people who took risk in a company were the shareholders, and therefore they should get all the cash that was available in the company, and they had a right to it. And so what happened was that in 1982, the Securities and Exchange Commission, under a Wall Street banker named John Shad, who thought that the more money you had going out into the financial markets, the more capital formation you had. He was actually a big fan of derivatives coming from Wall Street. We know where that led us. And he basically pushed through a rule. It was very obscure, frankly, until I started writing about it several years ago, and it's called Rule 10b-18, which basically says that companies can do massive amounts of stock repurchases and not have any fear of being charged with manipulating the market. And that's where the issue of legality, illegality comes in. Buybacks were never really illegal, but it always was possible before November of 1982, in the adoption of Rule 10b-18, that if you did too much in the way of buybacks, the SEC might say, hey, you're manipulating your stock price. And what I'm talking about here is open market repurchases, just telling your broker to go buy stock on the market. And that's actually what it is. It is a manipulation of the market. The rule that came in not only said that you can do large-scale stock repurchases, the actual amount that you're allowed to do under a safe harbor is 25% on any single day of your average daily trading volume over the previous 4 weeks. Okay, now what that means, if you take a company like Apple, within the safe harbor, that 25% of the average daily trading volume over the previous 4 weeks, they can do about 1.4 billion a day. Microsoft can do about 750 million a day. Many companies can do 250 million, 100 million, depends on their trading volume and the price of their stock.
Okay, so Bill, let me just so the long and short of it is, when these companies do these stock buybacks, it pushes up the price of the stock. They are incentivized to do this not just for the shareholders who buy the stock in the open market, but because the C-suite, the board of directors, they are all paid in stocks, essentially, either in options or in specific stocks that's been issued to them. They do that because of the capital gains tax structure that we have, that also was implemented in the 80s, at least in a more extreme way. And so there's a misaligned incentives by the leadership of the company. Now, so let me ask you this, and we got to take a break in just a moment. But before we do, so assuming that this ideology was manifested itself, this shareholder value ideology manifested itself in the idea of capital gains taxes being reduced, but also in the relaxing of circumstances where you could do stock buybacks. And there's been substantial reporting that the SEC doesn't even uphold the minor restrictions on it. Why are stock buybacks necessarily any worse than, let's say, paying dividends?
So dividends, first of all, you have to pay dividends to everybody who holds shares. And dividends give you a yield for holding stock. Now, that having been said, we know that stock holding is very highly concentrated in the United States. According to the research by Ed Wolf, about 84% of the stocks are held by about 10% of households. But at least all those households are getting a dividend, and those dividends can be too high. But what has happened since the mid-1980s, when basically the SEC legalizes what I call the looting of the business corporation in the United States, buybacks have been on top of dividends. And buybacks, the way you make money from buybacks is by getting a price boost and timing the buying and selling of shares. And in the case of executives, that is through exercising their stock options and then selling the shares, getting their stock awards and selling the shares, and that's how they make their gains. And by the way, it's actually not related to capital gains tax because the ordinary tax came down, of course, in the 1980s, and most of these gains are taxed at the ordinary tax rate, almost all of them. So it's mainly about just their executive pay, but if you take the pay of top executives in large companies, 60 to 85% of it is stock-based. So the majority is either the gains from stock awards or stock options. And they're incentivized to get the stock price up, and stock buybacks are a great way of doing it. You can also hit earnings per share targets. Yep, go ahead.
All right, Bill, we got to take a break, but when we come back, I want to talk about that, and I want to talk about a potential solution that's been introduced by Bernie Sanders and Chuck Schumer together, of all people,